Every year it shows up in the mail. Your property tax bill. You look at the number, you sigh, and you pay it, because that's just what you do. But here's what almost no one tells you: if you're 65 or older, there's a very real chance that number is higher than the law actually requires you to pay. Most states and counties have special property tax breaks just for seniors, exemptions, freezes, homestead reductions. They can knock hundreds, sometimes thousands of dollars off your bill every single year. But here's the catch that costs people the most: in many places, nobody applies them for you. You have to claim them yourself, and if you never do, you just keep overpaying, quietly, year after year. Today I'll walk you through the main senior property tax breaks, show you with real numbers what they're actually worth, tell you the one mistake that costs people these savings, and give you the exact steps to check what you're owed. I'll even walk through a real-world example with a couple I'll call Richard and Martha. Stick with me to the end, because the part most people get wrong is near the finish, and it's the part that costs the most. I'm Ray. Let's get you money back. Quick and important, I'm not a tax advisor, and this is education, not tax or legal advice. Property tax is *local, it changes by state, by county, even by city, so the exact rules and dollar amounts where you live will be different. My job is to show you what to look for, so you walk into your county assessor's office knowing exactly what to ask. Always confirm with your local tax office before you count on anything. Every dollar figure I use today is just an example to show how the math works, and one more thing, these breaks * change. Some states raised their senior exemptions just in the last year. So always check the current amount where you live. Okay. Let's start with why so many seniors overpay without ever realizing it. Here's the quiet truth about property taxes. For most people, the bill just runs on autopilot. It comes once or twice a year, maybe it's bundled into your mortgage escrow, and you never really question the number. You assume the county has it right, and that whatever breaks you're entitled to are already baked in. But property tax relief usually doesn't work that way. Most senior exemptions are opt-in. The county isn't going to call you on your 65th birthday and say, "Good news, here's your discount." You, or someone helping you, has to know the break exists, and then file for it. And think about how that compounds. Property tax isn't a one-time bill, it's every year, for as long as you own the home. So a break you fail to claim isn't a one-time loss. If a senior exemption would have saved you, say, $800 a year, and you go 10 years without claiming it, that's $8,000, gone, quietly, while you assumed everything was handled. It gets worse in two ways. First, many people who did qualify years ago don't realize that some exemptions have to be renewed, or that new breaks unlock as they cross age thresholds, 61, 65, 70 in some places. Second, life changes, retirement, a drop in income, the loss of a spouse, can suddenly make you eligible for breaks you never qualified for before, and almost nobody goes back to check. The good news? Once you know the categories, checking is straightforward. Let's go through them, starting with the big one, and I'll show you the actual math. The most common break is the homestead exemption. In plain terms, it reduces the taxable value of your primary residence, the home you actually live in, so you're taxed on a lower number. Let me show you the math, because this is where it gets real. Say your home is assessed at $200,000. And let's say your local property tax rate works out to roughly 2% of assessed value. Without any exemption, 2% of $200,000 is $4,000 a year. Now say your area offers a $50,000 homestead exemption. That drops your taxable value to $150,000. 2% of that is $3,000, so the same house, in the same year, costs you $1,000 less. And remember, that's not a one-time $1,000. It's every year. Over a 15-year retirement in that home, that single exemption could be worth $15,000. Here's the part people miss. Many places offer a standard homestead exemption to all primary homeowners, and then an asterisk additional homestead amount specifically for seniors 65 and older, sometimes a bigger reduction, sometimes a separate credit on top. People claim the basic one, assume that's everything, and never add the senior portion. A few rules to know: it generally has to be your primary home, not a rental or vacation property. Some areas grant it automatically once you're on record. Many require a one-time application with proof of age and residency. So even if you think you have Homestead, it is absolutely worth confirming you've got the senior layer too. Next is a break that can be even more powerful the longer you live in your home, and it's the one people understand the least. This one is often called a senior freeze, an assessment freeze, or a tax ceiling. The name changes by location, but the idea is powerful. Normally, as your home's assessed value rises over the years, your property tax rises right along with it. A senior freeze can lock in your home's taxable value, or in some places the actual tax dollar amount, at a certain point once you reach the qualifying age. So while your neighbor's bills climb as the market goes up, yours stays flat. Let me show you why this is so valuable over time. Imagine your home is assessed at $200,000 today, and your tax is $4,000 a year. Now imagine home values in your area rise about 5% a year, not unusual in a hot market. Without a freeze, in 10 years that home might be assessed around $325,000, and your tax could climb past $6,500 a year. With a freeze locked in at today's value, you'd still be paying based on that original $200,000, roughly $4,000. Over those 10 years, the difference adds up to many thousands of dollars you simply never have to pay. Now, the rules vary a lot, so listen carefully here. Some places freeze the assessed value, some freeze the tax amount, some only freeze the school tax portion, and many have income limits attached. Almost all of them require you to apply in the specific year you become eligible, and if you miss that window, you may not get it backdated. That's exactly why knowing your local age and income thresholds matters so much, and we'll cover how to find them shortly. But homesteads and freezes aren't the only breaks. There's a whole category that seniors fall into without realizing it. Beyond the general senior breaks, there are targeted exemptions, and many seniors qualify for these and have no idea. First, low or fixed income relief. A lot of areas offer extra reductions, credits, or circuit breaker programs for seniors whose income is below a certain level. And here's the part people miss. In retirement, your taxable income is often much lower than it was during your working years. So you might qualify now even if you were turned down, or never bothered, back when you were working. Now, not every state does this. Some, like Texas, have no state income tax and tie their senior breaks to age rather than income. That's exactly why you check your own state. Second, veterans. Many states offer significant property tax exemptions for veterans, and even larger ones for disabled veterans. In some states, 100% disabled veteran pays little or no property tax at all. And several states extend a version of that break to a veteran's surviving spouse. If you or your late spouse served, this is absolutely worth checking. Third, disability exemptions. Separate from age, many areas provide property tax relief for homeowners with a qualifying disability. And here's the key word: stack. In a lot of places these aren't either or. A senior, who's also on a fixed income, who's also a veteran, might qualify for several breaks at once, and the combination can cut a bill dramatically. But again, almost none of this is automatic. You have to know the category and claim it. Let me make all of this concrete with a real-world walkthrough. Meet Richard and Martha. They're 68 and 66, both retired, and they've lived in the same home for over 30 years. It's paid off. Every year their property tax bill comes, about $4,000, and every year they just pay it. They assume the county has everything right. One day Martha hears that seniors might be overpaying. So they do something simple: they pull out their latest tax bill and actually read it. And they notice something: the bill shows a basic homestead exemption, but nothing labeled senior and nothing for income. So Richard goes to the county assessor's website. He finds 3 things they were never using: an additional senior homestead exemption for homeowners 65 and up, a senior assessment freeze with an income limit they now fall under in retirement, and a small income-based credit. They call the office to confirm, and the clerk walks them through it. They fill out the forms, send proof of age and income, and apply before the deadline. The result? Their bill drops by roughly $1,200 a year, and the freeze means it won't keep climbing as home values rise. Over the next decade, that one afternoon of paperwork is worth well over $15,000 to them. Nothing about Richard and Martha is unusual. The only thing that changed was that they looked. Most people never do, and a big reason is the next thing I want to clear up, why this is so confusing in the first place. Here's something that trips everyone up. There is no single national rule. Property tax breaks are decided at the state, county, and even city level, and they look very different depending on where you live. Broadly, you'll see a few patterns. Some states are generous to seniors, big senior homesteads, strong freezes, and clear income-based relief. In these places, if you're 65 plus, there's almost certainly something you should be claiming. Some states lean on the freeze or tax ceiling approach. Your bill gets locked once you hit the qualifying age, which is fantastic in a rising market. Some states focus on income-based circuit breaker credits. The break is tied less to your age and more to how your income compares to your tax bill, which, again, often works in your favor after you retire. And a few states have relatively few special senior breaks at the state level, but even there, individual counties or school districts often have their own. The takeaway is simple: don't assume your state doesn't have anything, and don't assume what your neighbor in another state gets applies to you. The only way to know is to check your own county, which is exactly what we're going to do now. But first, the mistake that quietly cancels all of this out. If there's one thing to take from this whole video, it's this: the biggest mistake is assuming the break is automatic. People think, if I qualified, the county would have given it to me. But it's usually backwards. The county's job is to assess and bill, not to hunt down every discount you might be entitled to. In most places, the responsibility to claim is on you. The second mistake is giving up at the paperwork. The forms can look intimidating, the office hours are inconvenient, and people decide it's not worth it. But remember the math: this isn't a one-time payoff. Claiming a break can lower your bill every year for the rest of your life in that home. One afternoon against decades of savings is one of the best returns you'll ever get. So here's exactly how to check, and you don't need a lawyer for this. Start with your county assessor's or tax collector's office. Almost every county has a website with an exemptions or property tax relief page. Search your county name plus senior property tax exemption. Look specifically for a homestead exemption and any senior add-on, an age 65 freeze or ceiling, income-based relief or circuit breaker credit, and veteran or disability exemptions. Write down the age limits, income limits, documents required, and, this is critical, the application deadline. Then call the office. This is the highest value step. Tell them your age and your situation and simply ask, what property tax exemptions am I eligible for, and how do I apply? The people in that office do this all day. Have your property's parcel number and your ID ready. And if your bill still seems high compared to similar homes nearby, you can look into an assessment appeal, challenging the assessed value itself. But start with exemptions, because they're the easiest wins. Before the action plan, let me knock down a few myths that keep people from ever checking. Myth 1: my taxes are in my mortgage escrow, so it's handled. The truth is, escrow just pays the bill, it doesn't claim any exemptions for you. If you're not enrolled in a break, escrow is simply paying the higher amount on your behalf. Myth 2: I make too much to qualify for anything. Many senior breaks, like the basic senior homestead, have no income limit at all. And the ones that do are often set with retirees in mind, so your lower retirement income may put you under the line even if your working income never did. Myth 3: I already applied once, so I'm set forever. Some exemptions need renewal, and new ones open as you age or as your situation changes. Set a yearly reminder to recheck. Myth 4: it's only a few dollars, not worth the hassle. Run the math we did earlier, a few hundred to over $1,000 a year, every year, often frozen against future increases. That is not small money over retirement. Clear those out of your head, and the path is simple. Here's your plan. 5 steps. Step 1. Dig out your most recent property tax bill and find the assessed value and any exemptions already listed. Step 2. Visit your county assessor's website and read the exemptions page. Note every senior, income, veteran, and disability break, with its age limits and deadlines. Step 3. Call the assessor's office and ask directly what you qualify for and how to apply. Step 4. File the applications, gather your proof of age, residency, and income, and submit before the deadline. Don't let the paperwork stop you. Step 5. Set a yearly reminder to recheck. After birthdays, income changes, or any major life event, new breaks can open up. This is money you've already earned on a home you already own. The county isn't going to chase you down to give it back, but it's there, and now you know exactly how to claim it. If this opened your eyes, do me a favor and hit subscribe. I break down a money topic for retirees every single week. And tell me in the comments what state you're in, so I can point you in the right direction. Next time, I'm covering one that surprises almost everyone: how a paid-off house can actually become a tax trap, the debt equity problem. You worked your whole life to own your home free and clear. You need to know this. Don't miss it. Take care of yourself, and take care of what you built. I'm Ray. See you in the next one.